Hi, good morning, everyone. We are going to start our webinar now. So as you can see, we are going to have some sector update, company update, and we'll talk about the Astrea IV PE bond and round up with our Phillip 20 May monthly review. So this is our disclaimer. Please read it. We'll start with the land transport sector. So we published a report last week. Highlights is that taxi population is still contracting and rental cars year-on-year growth continues to moderate down. The deadline for attending training and passing the tests is approaching, yet 40% of drivers have not attained their PDVLs. We maintain overweight on the land transport sector because of the positive industry restructuring and regulatory action coming into effect, which levels the playing field between private hire car drivers and taxi drivers. We maintain a accumulate on ComfortDelGro, and we have upgraded the target price higher to 269, which was previously 248. So what's in the news is that it was reported that 40% of private hire car drivers have not passed the test for the private hire car drivers vocational license. They were given a 1-year grace period to pass the test, and the grace period is coming to an end on 30th of June this year. So if they do not pass the test by then, those who have not passed will have to stop driving for the ride-hailing apps. The other news is that Uber's unhired cars, which is from Lion City Rentals, have been put up for sale in the used car market. This is evidence that the rental car population had grown too quickly and there is an oversupply. There was also a news that the new Singapore-based ride-hailing player, Cardi, also will join on 5th of June. And LTA has also published their data for taxi and rental car. So you can see here for taxi, April 2018 is down almost 20% year on year from April's 2017. And if you compare on a year-to-date basis, taxi population has declined 7.4%. Meanwhile, rental cars year-on-year is almost 15% higher, but has remained stagnant on a year-to-date basis. The positives for the sector is that the exit of Uber has had a positive effect with this, and it has restructured the ride-hailing industry. The positive effect came from the reduction in driver incentives and rider promotions, and that has shifted some demand back to taxi. As mentioned, there's a deadline for private hire car drivers to get their PDVL, and this is a significant leveling of the playing field between them and the taxi drivers. Rental car growth also continues to moderate down, and the population has been stagnant year to date. The negative is that Grab still maintains a dominant position in the ride-hailing space. Investment action, we are maintaining overweight on land transport sector for two positive structural issues. That is industry restructuring following the exit of Uber, and regulatory action coming into effect, which levels the playing field. So there's a deadline for private hire car drivers to get their PDVL. And we maintain accumulate for ComfortDelGro with a higher target price of 269. Now I'll talk a bit more about our ComfortDelGro report that was also published last week. So as I mentioned, we have maintained accumulate. We are forecasting 10.4 cents dividend. This will give you a 4.3% yield based on last close price last Friday at $2.40. So 10.4 cents is actually the same amount as FY17 full year dividend. So we are expecting FY18 dividend, FY18 full year dividend to be 10.4 cents or more. For ComfortDelGro, the worst appears to be over for their taxi business. This is signaled by the growth in their bookings and the capex for new hybrid taxis. They've also terminated their strategic arrangement with Uber's Lion City Rentals. At the same time, outlook for rail is positive with the narrowing of downtown losses driven by ridership growth. So for news-wise, ComfortDelGro Taxi made a media release to say that they have seen an uptick in bookings for 5 months of 2018, and for the month of May, it was a 9% year-on-year increase. This is the biggest jump since September 2014, and the company attributed this uptick in bookings due to the exit of Uber and promotions given by them to passengers. At the same time, ComfortDelGro has also called for a tender to supply 500 more hybrid taxis. This comes soon after they had purchased 200 Hyundai Ioniq taxis in early May. They've also terminated the agreement with Uber, so they will not be acquiring the stake in Lion City Holdings because the basis for the partnership no longer exists. But at the same time, the company still maintains that it intends to get a stake in the private hire vehicle space. So positives is that the purchase of new taxis and bookings growth are signaling that the worst is over. Negatives is that for ComfortDelGro to get into the private hire space, they intend to buy cars and lease them out. So that will be an asset-heavy business model. We maintain accumulate for ComfortDelGro, higher target price of 269. This is an implied forward PE multiple of 18.9 times. I've stated that our forecast is for 10.4 cents dividend this year. This will be the minimum, and it's the same as FY17. 10.4 cents is quite a reliable estimate as it's supported by positive free cash flow from the group. Next, we will move on to Teo Hong, who will talk about the Astrea IV PE Bonds.
Hi, morning clients, Teo Hong here. I will go on to touch on the Astrea IV PE bonds. I think most of you could already have been very familiar with this given the marketing that they have embarked on last week. But briefly, I'll just touch on the highlights of the offerings and what are some of the commonly asked questions. So in summary, Astrea IV PE bonds, this is a bond, a tranche of retail bonds, the first ever listed PE bonds for retail clients, launched by one of the subsidiaries of Temasek, Azalea. This is the fourth issuance from Astrea. So Astrea IV PE bonds, the tranche for retail clients will be part of Class A1, as you can see in this red box. The total A1 tranche is 242 million, but what is available for retail clients will just be around half of that. The coupon on these bonds will be 4.35% per annum on a semi-annual basis. How these bonds work will be that they will be effectively maturity is 10 years, but for the first 5 years is non-callable. And so there is this reserve mechanism as well. If you look at our report, there is this cash flow distribution waterfall. And so if you flow down so let's say we come to a distribution date every half a year. After paying off taxes, expenses, some of these bond coupons, there's this clause whereby the sponsor will have to set aside funds to put into the reserves accounts, and this amount will be earmarked for the principal repayment of all these Class A1 and A2 bonds. So upon the 5-year mark where there's a non-callable period, if the reserves account there is sufficient amount to redeem the principal, for Class A1 bonds, they will have to do it, failing which then there will be a one-time step-up coupon of 1% to 5.35% for A1 and 6.5% for A2. And so if you look at the total LTV of the three classes of bonds that we're going to issue is about 45.6% on a total NAV portfolio of about 1.1 billion US. So these bonds primarily, they are backed by underlying cash flows from a portfolio of 36 PE funds. And these 36 PE funds have invested in around close to 600 investee companies. So essentially, you can see this as a fund of funds. While there is also a well-diversified sector breakdown, if you look at this, the chart on the left-hand side, you can see the sector breakdown is pretty evenly spread out. And there is no single one investee company out of this 600 that occupies more than 3% of the total NAV of 1.1 billion. There is also an average fund age of about 7 years. If you look at this breakdown of the different funds, ages of the funds that they have invested in, it's pretty well spread out as well. The average fund age is about 7. And the good thing about this average fund age of 7 is, if you can look at this right-hand side table with me, there is this, historically, it's been proven and it's been shown that, as we all know, in PE, the cash distributions is very unstable, the visibility is pretty low. And it's been statistically shown that for PE funds in the first few years, generally, there is more often than not a call for cash instead of distribution of cash. But when you go towards the later years of the PE funds, where there's a bigger visibility and bigger traction of the underlying businesses of the companies they are investing in, then this is the period of time where the funds tend to make more distributions than cash calls. So as you can see in this pink box, there is a historical tendency for PE funds to deliver positive cash flows in the later years, which is why the average fund age of 7 is actually a structural safeguard in terms of to ensure greater visibility on the cash flows. And all in all, actually, the bonds will be entirely dependent on the performance of these underlying funds. And historically, it has also been shown that PE buyout funds, they have been seen to outperform public indices over the long term. So in summary, I mentioned earlier that the coupon for the A1 bonds is 4.35% semi-annual per annum. And the total LTV for these two classes of bonds, A1 and A2, which are the most senior within the capital structure. So A1 and A2, they are pari passu with each other. These two bonds, LTV is about 35.6%. And as I mentioned, public tranche available is only around 121 million. You cannot use CPF funds to buy. And some of the structural safeguards available would be, as I mentioned earlier on, the reserves accounts, as well as they have also secured this liquidity facility whereby if within the first 5 years there is no cash distributions from the underlying funds, then the sponsor can actually tap on this liquidity facility of 100 million thereabouts to actually pay off the interest cost on these bonds in the interim. So deadline for this public application will be tomorrow at 12 p.m. And so you can do the application at the ATM machines. Minimum size is 2,000 Sing. So I will pass on to Linson and Alvin for the coal sector.
Hi everyone, I'll be commenting on behalf of Guangzi for Geo Energy results. So we maintain our buy call with a lower target price of 41 cents. Generally, first Q18 results dropped year on year due mainly to relatively poor road performance, resulting in unfavorable weather conditions and high cash costs. However, the coal prices were still strong in first Q. The year-on-year growth arrived at 12%. The price corrected a bit in March and April due to restriction on seaborne coal from China, but rebounded recently according to IHS market projection. 4,200 GAR price will be traded at high 40s in 3 years. The annual production target of 11 million tons is still on track. The cash cost will jump this year due to the commencement of production in TBR mine in June. The expected cash cost will be at low of US $30 per ton, comparing with US $28 per ton last year. We are also upbeat on Geo and looking forward to its acquisition in the near term. The potential target will be a coal mine with 50 million to 60 million tons of reserve that can deliver 20% ROI. And I'll pass on to Lin Xin to talk about the coal sector.
Hi, this is Lin Xin here. So I'll just briefly bring you guys through this month's coal sector updates on behalf of Guangzhi. So what's happening within the coal sector in the past month is that if we look into China, the policy have actually remained roughly the same. The only changes last month was that China continued to push for more domestic production as they clamp down the seaborne coal imports, as what Alvin has mentioned just now. So they intend to ramp up production by at least 300k tons per day. Sorry, just to recall that why of these policies are being introduced is that the China is trying to bring back coal prices to a more reasonable or rational range. Nonetheless, as Alvin mentioned just now, that in March and April we have seen a dip in coal prices, but due to undersupply, which I will elaborate further in the next slide, the price has actually corrected. It has actually recovered ever since then. And we believe that even with the recent seaborne coal restriction, this may be lax due to the undersupply. And hence, we believe that the target price should maintain at about 570 RMB per ton. So to bring you guys through some of the trackers or indicators that we follow through every month. So the first two shows you the supply for coal. The first one is from China side and the second one is from Indonesia side. Nonetheless, sorry that we do not have the latest update on Indonesia's coal import figures. So nonetheless, let's take a look at the figure one. So figure one, we continue to see that is actually on a downward trend here. But on figure 3, which shows you the demand for coal, is still on an uptick, where this shows that there are strong demand for coal. So these three actually gives you a conclusion that the coal sector or the coal demand is actually undersupplied in China side. Figure 4 and 5 actually shows you the coal prices. As mentioned just now, in April and March, it actually came down, but we have seen in the recent price, it actually shows an uptick. Nonetheless, as for the port coal inventory, it remains high, and this actually infer that the coal supply for the coming summer remains high. So overall, undersupply situation, a supported price, as well as a relatively high demand for the upcoming season, actually gives us a positive view on the overall coal sector, and hence we maintain our buy call on both our coal counters. Geo Energy Resources at 48 cents and Geo at 41 cents, both at buy. So with that, I'd like to pass on the presentation to Jeremy, who will talk about Phillip 20.
Good morning, everyone. Jeremy speaking here. So I'll just run through with you guys the Phillip 20 portfolio, basically what happened in the month of May, as well as the Singapore's market from the STI perspective. So let's just dive right straight into it. So as you can see over here in the chart, we are just highlighting the STI on a weekly time frame perspective. And just to give a heads up, our near-term outlook for the STI on the technical analysis perspective is we are expecting this most recent correction that happened about 5 weeks ago to kind of continue itself. And near-term outlook-wise, we are expecting this sell-off correction to take the STI back down to retest this key support area at 3,341 point in the near term. So just to illustrate again why we have this particular bearish outlook, at least in the near term, is mainly caused by this resistance that was formed back in January. So in January, we actually experienced this sharp rally in price, which brought the STI back to this reference point of this high point at 3,611 points. And this level kind of came into play more recently in April, where we actually broke above this 3,611 high. Hit a high of 3,641 points, but ultimately in this particular week, somewhere in April, after breaking this high, the bulls kind of failed to sustain the gains, and ultimately with that, it closed at the week's low, and ultimately resulting in this formation of this bearish reversal candlestick pattern, a bullish outside bar. And hence, it's with this bullish rejection of this 3,611 resistance area that more or less confirmed to us that we are seeing this correction happening right now. And tying that together with the RSI, the relative strength index at this bottom panel, with this bearish reversal candlestick pattern, we got the confirmation of this bearish divergence. And what I mean by a bearish divergence, for those that are unfamiliar with this, basically the STI at this particular week ended actually from a higher high point. But on the flip side, look at the RSI, it actually formed a lower high point, and all in is with that structure that's signaling to us that the market is actually weaker than it is. And hence, with the bearish reversal candlestick pattern in this particular week, as well as the bearish divergence pattern that happened then, kind of confirmed to us that this correction played out. We mentioned this in the last month's monthly report, and with the benefit of hindsight, this correction played out pretty nicely, and we are still in the midst of this bearish divergence kind of formation here, and is with this recent bearish reversal candlestick pattern as well as bearish divergence, we are expecting this correction to last for a few more weeks out for the STI to retest this 3341 key support area. And all in, I've highlighted this area over here to kind of show you the range that we are right now kind of bounded at. So we are definitely trading within this range, range high being this 3,611 point, and hence on the flip side, the range low at 3,341 support area. So all in, we expect near term for the STI to retest this 3,341 support area, probably before seeing the long-term uptrend kicking back into gear. So all in near term outlook, we are expecting the correction to play out. But on the flip side, on the longer term perspective, you can see this uptrend since 2016 holding up pretty nicely, mainly due to the structure of this series of higher highs and higher lows still pretty much intact. And hence, we place a lot of emphasis on this 3,341 support area because this is the next higher low point reference that the market is definitely watching. So all in, for this long-term uptrend to remain intact, the long-term uptrend that was established back in 2016, this 3,341 support area needs to hold in the near term for this uptrend to stay kind of in play. So outlook-wise, we expect this 3,341 to hold the next time we test this area, and probably a rebound back to retest this 3,611 resistance area. So this is our outlook for the STI, at least on a weekly time frame perspective. And even on a daily time frame, we are continuing to see the weakness kind of forming from a daily perspective. So interesting price action wise that I want to highlight over here is this green line over here, which is a 200-day moving average. So 200-day moving average, at least on the daily time frame, is showing some significance. More so because you can see this sell-off that happened in January, as well as the sharp sell-offs that happened somewhere in March and April. All in, the sharp sell-off was halted perfectly off the 200-day moving average, which confirmed to us that this is a level that the market is watching closely. And even more recently in end May and early June, where we saw same thing again, where the price action showed some strong rejection of the 200-day moving average. But nonetheless, with the benefit of hindsight, the bullish rejection only lasted for around 2 to 3 days. And ultimately, once price nears the 20-day moving average, the red line, you can see the buyers kind of re-emerge again. So all in, our current price action still suggests, at least on the daily time frame, that the bears are still dominating price, and there's a higher likelihood that we would definitely break below this 200-day moving average. And once we break below the 200-day moving average, it's highly likely that the STI will kind of retest the key support area, like I mentioned again, the 3350 area, the 3341 support area, the higher low point that the market is closely watching. So near-term outlook and near-term outlook and the long-term outlook are still suggesting for a weaker move for the STI to retest this 3341 support area. And just another highlight over here is how the 20-day moving average has already crossed below the 60-day moving average, the red line below the blue line. That by itself is also suggesting to us that the near-term trend has also turned down. So keep a close lookout if we do actually really break below the 200-day moving average, how price will respond at this 3341 support area, whether this key level, higher low point at 3341 holds up or not for the next wave of buying to begin. So highlight for the Phillip 20 portfolio, basically for those that haven't been following the Phillip 20 portfolio, is basically a portfolio that's constructed based off technical analysis and a total of 20 stocks within this portfolio. So this is the May's P&L. I haven't gone through the performance for month of May. So for the month of May, STI was down 5.14%, basically wiping out whatever gain that was made in April. April, we had a good run of 5.4%, but in the month of May, everything flipped. And net for the past 2 months, the STI was pretty much unchanged. And hence, with the negative sentiment in the month of May, Phillip 20 portfolio was hit pretty hard as well. So here are some of the trades that triggered their stop loss: Golden Energy, Riverstone, Miyoshi, Sembcorp Industry, Jumbo, as well as UOL. And these are the respective P&L. And with these 6 trades out, we managed to get into new 6 trades in the month of May, specifically China Everbright, ComfortDelGro, Memtech, Jardine CNC, Wingtai, as well as Geo Energy. And here are the respective P&L as of last Friday. And all in, the monthly performance for the Phillip 20 portfolio is stated here. So for the month of May, the Phillip 20 portfolio was down roughly around 2% as compared to the STI of 5.14%. And net in terms of total return since inception, since May of last year, the STI was up around 7.9% as compared to the Phillip 20 portfolio of around 0.5%. And to bring it back all in summary, this is the current watch list that we are monitoring for further inclusion of stocks to the Phillip 20 portfolio. So here are the lists of stocks that are still looking good in terms of holding on to its uptrend. And we continue to watch this space for further opportunities to enter into the market that adds into the Phillip 20 portfolio. And last but not least, here's the current snapshot of the Phillip 20 portfolio as of last month, 31st May. Yeah, and with that, we've come to the end of today's webinar. We'll pause right now for Q&A if there is any question. Thanks.
Hi, there are some questions on the Astra. I will touch on them. First one is the distribution dates will be June and December every year. And then the structural safeguards I mentioned on the reserves accounts. These are characteristics that are specific to the Astra vehicle. And the previous one, Astra 3, actually, Astra 3 had a similar structure for the reserves accounts. And I think just for your information, the previous one they issued in 2016, they were supposed to, the non-call was for 3 years. So it was until 2019 non-callable period. And so for the period from 2016 to 19, they are supposed to have this structural safeguard where they put aside money into their reserves accounts for the payment of the principal in 2019. And right now in 2018, 2 years into the issue of the bonds and 1 year before the scheduled payback, the first payback of date, the reserves accounts amount is already more than the principal of the bonds. So if you need a reference point, I think that is a good reference point. And okay.
Hi, there's a question asking, does our Phillip 20 portfolio include ST Engineering? As of now, it's not inside the Phillip 20 portfolio. So whatever that is here in the watch list are basically the stocks that are trending up. And from our technical perspective, we still see the uptrend holding for these counters over here. So right now we are just watching for possible correction to happen within this watch these over here, and waiting for some kind of a bullish reversal candlestick pattern of those correction in order for us to get back into possible opportunities for all these watch these over here. So we are still currently monitoring the stocks over here for possible correction to come into play. And once we see the end of the correction, probably that will be the time where we update in our technical pulse daily report, where we see opportunities as well as the entry price, take profit, as well as stop loss when the opportunity arises.
Hi, there's another question on the Astrea bonds, on whether the SRS can be used. So CPF cannot be used whether it's the initial application or the subsequent listing. SRS cannot be used for the initial application, but subsequent listing is possible to use. Okay, if there are no further questions, I think we will call an end to our webinar this week. So hope to see you guys again next week. Thank you.